So I would like to welcome you all to our third Financial Economics Workshop. We have two speakers. I'm going to introduce them now, and then we'll have the presentation by Dr. Benigno, followed by the presentation of Dr. Piersman. Pier Paolo Benigno is a professor of economics at Luis Guido Carli. He is a research fellow of CEPR and EIEF, the Einaudi Institute for Economics and Finance. He holds a degree in economics from Bocconi University and a PhD in economics from Princeton. He previously taught at NYU and Columbia. Benigno areas of research are open economy, macroeconomics, and monetary economics. He has published articles in leading academic journals and is currently the co-editor of the International Journal of Central Banking. So please, let's give him a hand.
Thank you very much.
I'm going to quickly introduce also Professor Piersman, who's here. He's a full professor at the Faculty of Economics and Business Administration at Ghent University. His research fields are monetary economics, monetary policy, and empirical macroeconomics. He has published his work in journals such as the American Economic Journal Macroeconomics and other top journals. He is also associate editor at the Journal of Business and Economic Statistics, and in addition, he's a frequent advisor of central banks worldwide, is very active in the Belgian public debate on economic policy issues, and writes a monthly column for the Belgian newspaper Die Standard. Together with Koen Schurs, he has written the popular economics bestseller The Perfect Storm on the Economic Crisis. So again, let's give him a hand and welcome him. As you can see, we are videotaping the session. It will be posted on YouTube, and so whoever is interested, I can send you the link. It will also be posted on our Facebook page as well. Thank you.
Okay, thank you very much, Leila, and everyone for the invitation. It's a pleasure to be here. So I'm going to present a paper on private money creation, liquidity crisis, and government intervention. So this is a joint work with Roberto Robatto from University of Wisconsin. So the motivation from this paper starts from the observation that the financial crisis has shown us the existence of two classes of money-like securities. What are called safe assets, which mostly are treasury securities, has provided liquidity in services in all times, and there are sort of pseudo-safe assets which are produced by the shadow banking sector that at the height of the crisis lost their value and their liquidity properties. So we are going to talk in this paper about these two classes of securities, and the crisis has also shown a lot of dimensions through which the government intervene by providing more supply of public liquidity through deposit insurance and also through central bank purchases of private risky assets. And moreover, there has been a lot of discussion and enforcement of regulatory procedure into the banking sectors. Now, this kind of swings in the creation and destruction of private money and liquidity have characterized almost every episode of deep financial crisis in the modern monetary history. So they are not really a new phenomenon. And the motivation here to talk about these issues again start from asking some critical questions. So the first one is that we are going to investigate is who should be the supplier of liquidity into the system? Should be the private sector or should be the government? And in the case is the private sector, which kind of backing these securities should have? And if not about backing, should there be regulation of creation of private money? And in the case is the government, the one who should be responsible for producing these securities, how can the government produce these securities? So these questions are really not new. We are using the fancy and more up-to-date word of safe asset, but you can substitute that word with liquidity or money and ask the same question in the past. For other episodes of financial crisis. And indeed, the debate is pretty old, and for centuries, economists have been debating about who should supply liquidity and which kind of backing should the supplier have. In a famous doctrine called the real biz doctrine, the issuance of liquidity should be private and under unfettered competition. Moreover, the backing that this security should have should be real bills, okay? And those are sort of private security, free of any risk. So basically, intermediary should be in a market of competition, issuing this liquidity and holding as asset to back this liquidity real bills. Then there are theories which are more extreme than these, which propose, again, competition as the environment in which creation of liquidity should occur, and in particular competition, private competition, obviously. And in this case, it's just sufficient, like in this free banking theory, you know, that are associated to the name of Hayek. In this free banking theory, it's sufficient that is competition the element that should be enough to create in an efficient way liquidity into the system. Then there are also theories which go on the opposite side of this, proposed by Friedman, narrow banking theory, in which liquidity should be supplied just by the government, and there should be separation eventually in the market of intermediary from intermediary that issue liquidity and invest in safe security issued by the government, or other intermediary which are instead providing loans to the economy. So this is narrow banking theory because separate the banking sector into in a sector providing loans and in a sector instead issuing liquidity and investing in safe securities. Okay, so we're going to revisit these debates in a hope model framework. So what I'm going to propose is going to be a simple two-period general equilibrium model, and it's going to be a model of endogenous creation of private securities. We're going to have two securities which are going to be created in this environment. One is going to be a safe security issued by intermediary that choose to invest in a risk-free, low-return technology. And there is a pseudo-safe risky debt in which is going to be issued by intermediary that choose to invest in a high-risk return technology. And this is the decision of intermediaries in which security to invest is going to be endogenous. So it's not going to be something we're going to impose. Now let me move so after the findings, and I will present the model first. Okay, so the model is going to be a two-period models. So the two periods are going to be 0 and 1, and at time 1 there are two states of nature. So at time 0 there is no uncertainty, but at time 1 there is uncertainty. And there is a state H with probability 1 minus pi, and a state L with probability pi. Consumers have the following preference. They consume a good X in period 0, and then depending on the state of nature, they consume two goods in the period 1. So a good C and the preference toward the good C are logarithmic, and a good X with the preference linear. And you see here the state H and the state L. So the constraint of this agent is that they start at time 0 with some endowment and some bonds. You know, those are not important. But what they're going to do is to invest in three types of security, which are going to be endogenously determined in the model. So, but those are potentially the security in which agents can invest, consumer can invest. B is going to be a risk-free government debt. So that's a safe asset. Is going to have a unitary payoff in each of the state of nature at time H and L, and it's going to be have a price QB at time 0. There is going to be also a safe security, and we'll see whether the private sector is going to produce this security issued by the private sector with the unitary payoff in each state of nature. And there's going to be a risky security issued by the private sector, which is going to call the pseudo-safe asset, which is going to pay only in the state, high state, and is going to pay zero in the low state.
So what's the difference between this private and public safe asset in terms of payouts? They look identical.
Right. There's going to be a difference in terms of creation, and I'm going to explain. It's going to be key. But if there is no that difference, I'm going to explain they're going to be very similar. Okay. So now we have to consume these two goods, you know, H and X, in the high and low state respectively, and CH has a characteristic to be a particular good subject to a financial friction. You can purchase this good only with securities. Okay. And this is going to give us a demand of securities. So in the state H, you can use the 3 securities. In the state L, you can use the 3 security. But D is going to be fully defaulted, so it doesn't pay anything here. Okay? So you can't use it. And we're going to see under which condition this D is going to be produced in the economy. And this is going to be eventually explaining the crisis in this model. Now, given this consumption, the consumption of XH and XL is going to be residual, basically. Okay? And at the time in which you're going to consume the goods H and L, you're going to be taxed. Okay? So here you're going to get the payoff of the securities, you get the profit from intermediation, and then you have to subtract the consumption in the 2 states. Okay? So those are the budget constraints. So basically, it is the problem maximizing this utility, simple utility, under these constraints. So what is going to happen as an optimality condition? Now, let's look at the consumption CH and CL. This is going to be key for understanding all the result. So this is going to be inversely related to the Lagrange multiplier, which is the Lagrange multiplier attached to these 2 constraints. So note first that at the first best in this model, consumption should be equal to 1 in both states. Now, the fact that there is a liquidity constraint, so that this Lagrange multiplier can be non-negative, can lead to suboptimality of consumption. Okay? So the economy would be better if this liquidity constraint would be relaxed. Okay? So that's the first best. Now, at this given these budget constraints, there's going to be a demand of safe asset, which is going to depend on the price of the securities. And the price at which you are going to demand that the security is going to be positive is this one. So basically, QB and QS, which are the government safe security and the private safe security, are going to have a price which is going to be related to the payoff of the securities, which is 1 in both state of nature, plus you get the liquidity premium, right? You get the liquidity premium in the high and in the low states. What about the security D? Well, that is going to pay only in state H. So you're going to get 1 in state H with this probability, and you're also going to get the liquidity premium. But you're not going to get anything in the state 0. So that is going to be the price at which you're going to hold those securities. Okay? So this is the demand side. So basically, this consumer in the economy is willing to hold these securities at these prices. And you see that this price is going to be higher than this, right? Because it's going to have more payoff and liquidity premium. But this liquidity premium are going to be determined in the model endogenously. Okay? So let's look at the block of intermediary. So intermediary are going to be, they're going to invest in 2 types of capital. So there is a safe capital with unitary payoff in each state of nature. So basically, I can invest, give a loan, suppose I give a loan, and this loan is always paying 1, okay? So the only problem is that if I want to go in this market to produce this loan, I have to follow up this loan. So I have to pay a cost, tau, okay? Now, there is another possibility for intermediary is to go to a risky capital. The risky capital pay more in state 1, in the good state, but pay 0 in the state L. And he has the same expected payoff as this safe capital. But it doesn't require monitoring, okay? Or selection, okay? So you don't have to follow up.
Sorry, why it doesn't pay negative in low state?
Why negative?
Why does it pay negative?
Well,
Why zero?
0 is important, actually, that he pays 0. Negative could work, but I'm going to explain why negative is not important here. Okay? So it's basically, it's not, no, don't take the payoff as the return. So the return is infinitely negative here, right? So it's actually what we are going to get. So you invest on K, and you're going to get 0. So the return is negative. Okay, so, right?
Just like an option.
Yeah, so it's completely, you know, it was completely a fake capital there, you know, you're not getting anything out. Okay, so, and we have an infinite number of intermediary, so think about this infinite number of intermediary here that are trying to enter in this market, okay? So they can choose in which market to enter, and which asset to purchase, and which type of debt to sell, to manufacture, okay? So everything is going to be endogenous. We are just putting as exogenous this technology, and this intermediary are choosing where to go and what to supply in order to raise securities. Now, a key assumption we are going to make on intermediary is that they're going to be subject to limited liability, in a sense. If you're going to make losses, right, they're going to default on that. They're not going to raise equity or making anything to face those losses, okay? So they're basically defaulting on that. So this model is going to become also a model in which there is creation of securities and endogenous default.
Without adding the guarantee.
Yes, the guarantee will be important later. I'm going to talk about this. Now, let's think about, you know, think about an intermediary that enters the market of safe securities. Time 0 balance sheet. It's very simple. I issue S at the price QS, okay? Safe security, because I'm going to produce those safe securities. And I'm going to invest in capital, which is safe capital, but I'm going to pay this cost to screen it. So next period, this capital is going to have payoff 1 in all state of nature. And what you are going to do, you're going to pay back the debt, okay? And the profits are going to be exactly this, the capital minus the debt that you pay. Now, if you put this balance sheet into the profit condition, you're going to see that the price at which these agents, these intermediaries, are going to supply safe security is going to be such that it should be at least greater than the payoff of the security plus the monitoring cost. Okay? So you remember I show you the demand side, now I'm showing you the supply side. So demand is going to meet supply and we're going to determine equilibrium. What about pseudo-safe private debt? Okay, suppose that I invest in the risky technology, capital D, I issue debt, which is going to be risky endogenously, at the price QD. Now, tomorrow is going to happen that KD is going to pay AH, okay, in the state, in the good state, and then you're going to repay debt, right? Because you have enough resources. But what is going to happen here? That you're going to receive 0, but you have debt outstanding. What you are going to do? You're going to default. So there is endogenous decision of defaulting because you don't have any way to guarantee those losses. So you're going to make your security defaulted. And this goes back to our initial assumption there, which was not an assumption that the security do not provide liquidity in the low state because they are defaulted. So they're completely defaulted. Why? Because they invest in the bad technology. Now, what about the price at which you are going to supply this security is going to be at least greater than the expected payoff of the security, 1 minus P. And it comes from working with this condition, just it. Okay? Now, demand, supply. Let's see when demand and supply meet. But first, on the supply side, we have to use the assumption. So far, I just pick up an intermediary going into the market and see, oh, you're going to supply these securities, the price is enough. Now, let's see what competition is going to do. Well, basically, competition is going to abate to zero all rents. And here we will have intermediaries that are going to go where the rents are, but eventually, if I enter in that market, everyone is going to enter because there are rents. What does it mean? It means that the supply of the two securities is going to be flat at these prices, okay? Which are the prices I showed you before. They were abound, there were some rents there, but if those markets are going to be open, the rents are going to be zero. Okay. So, intermediary is an important agent. The other agent that can issue securities in this model is the government. Remember the security B. B is a safe security by definition, and here I'm going to explain a little bit. So the government can manufacture these safe securities. So we are going to assume that they're going to manufacture, and how they're going to manufacture depend on their budget constraints. So basically, depend on how much taxes they're going to rise. Okay? Now, let's go back and just solve the model in a sense. So remember here, the best that can happen is that consumption is equal to 1 in both states of nature. I have a government. B shows up in both sides, right? What can the government do here? Very simple. Can just set B at least equal to 1. You can reach the first best. So this is actually a Friedman proposal here. The government can solve all the problems of liquidity by just raising enough taxes. Okay? And consumption will reach the first best. We are going to discuss this later, but here you see Friedman proposal. Okay? Now let's see, behind this proposal, what the private sector can do. So let's see whether there is some rationale here for what Hayek was saying. Oh, you should let the private sector to produce these securities, and they will do it in an efficient way. Okay? Because eventually, it means here that the government can do it, but it has to raise taxes, right? Eventually, taxes may be costly. So why we don't see much production of safe asset by the government is because they have also a costly technology. All right. So equilibrium. So this is the supply, and this is the demand. Okay? And I'm going to cross them, and I'm going to tell you what is going to happen in equilibrium. Now, first case, just to warm up, is suppose that this monitoring cost is equal to 0. So tau is equal to 0. Which securities are going to be supplied from the private sector? Well, the result that we have here is exactly the following. The private sector is going to supply enough safe asset to satiate all the liquidity needs that there are in the economy. So the supply is going to be enough to complement even the government. Eventually the government is not supplying enough, the private sector is going to supply more, and such that to eliminate any liquidity premium that there are in the economy. Consumption is at the first best in all states of nature, even if public liquidity is 0. And what is happening is that the intermediary are going to choose to invest in the risk-free technology, not in the risky technology. Okay? Now, why this result? So this is a good result, and is a result in line with what Hayek was proposing. The process of competition enables private intermediary to supply the best securities, safe asset. And why is this? Because the private incentives are perfectly aligned with the social objectives. Now, what is the social objective here? Remember, the social objective is to have consumption equal to 1, which means setting to 0 that Lagrange multiplier, which is the liquidity premium. Okay? Now, suppose that no one is going to invest in the safe security, so it means that there are no safe assets on the private sector. So we're going to see some liquidity in the good state, but no liquidity in the bad state, because those safe assets are not provided. There are only the risky security. So there is a liquidity premium there. What is the liquidity premium for an intermediary? Is a lower cost of borrowing. So an intermediary that see that there is a liquidity premium there is going to enter in the market of safe security in order to exploit the lower cost of borrowing and get some rents.
In other words, the households are willing to pay the liquidity premium,
Right.
which lowers the intermediaries'
Borrowing cost. And the intermediary is going to enter in that market, which means that they're going to supply those securities. And then it comes competition. So everyone sees this, and they're going to flood the market of safe security, and they're going to eliminate all the rents. So you see, alignment of private incentives with social incentives. And indeed, Hayek was saying here, why we should give to the government the responsibility to provide liquidity into the system. You know, the private sector can do it because the incentives of the private sector are perfectly aligned with those of society. And indeed, why you want to give power to the government will be a monopolist here, right? And the monopolist, you know, we say, oh, let's just put t equal to 1. You're going to eliminate the liquidity premium. But what a monopolist would do in a market of liquidity when there is a premium? A monopoly would like to keep it. So you're telling the government to do something which is in contrast with what a monopolist would do. So Hayek was saying in his book on the nationalization of money, he was saying a monopoly prevents the discovery of better methods of satisfying a need for which a monopolist has not incentive. So let's have the private sector to do. And you can also see here that you are not even, you have not even to regulate the private sector, because you don't have even to tell them, okay, just invest in the risk-free security, risk-free technology. They're going to do it. So if you look from the perspective of the real bills doctrine, here you would have, you don't have to restrict intermediary to hold any type of asset. They're going to hold the good asset in a way to back the good money.
Can you say that the private, you know, in the 19th century there were private banks issuing private monies in the U.S. before?
Yeah.
Would this be an example?
Yeah, that's exactly that.
But some of them went out of business.
Some
of them, they didn't survive. They all didn't survive, I guess. Some were.
Yeah, exactly,
Yeah.
because then they were subject to problems.
They were not that safe.
There were monitoring costs. Yeah, which
Exactly.
we're going to see.
Right.
Yeah, but that private banking system is sort of like what Hayek envisioned, right? I mean, the private monies in the U.S. at that time,
Yeah.
19th century.
Yeah, exactly.
Red money, green money, whatever.
Yeah, exactly.
Money of First National Bank of Delaware.
Yeah.
Wasn't it like that?
Yeah, exactly.
Yeah.
And that's exactly why it's not a new question. So that's this model with tau equal to 0, as you can see, is a model with efficiencies reached, and there is no crisis, basically. So private sector can do everything here to achieve the social optimum. And this everything means consumption at the high level, 1 in both states of nature. So it's not a crisis model, so in some way. It's not something that depicts what the crisis was. Now, let's think the monitoring cost is positive. So I told you the story about this alignment between private incentive and social objective. This alignment disappears, is a bit, disentangled when there is a monitoring cost. Why? Because you basically need to have some rents to pay off this monitoring cost. Okay? So you don't want to supply all liquidity, right? Because if you supply all liquidity, you can't have rents. And how can you survive in the market if you have to pay monitoring cost? Okay? Now, the key result here is that when tau was equal to 0, we saw that there is no equilibrium in which the safe security are not supplied. Here, the key result is that when tau is greater than 0, there is no equilibrium in which instead the pseudo-safe security are not supplied. Why? Suppose that intermediary issue only safe securities. Safe securities allow you to have the same payoff in the high and low state. So consumption is going to be at the same level in both states. But it cannot be 1. Because if it's going to 1, you are going to kill this intermediary. There is no liquidity premium. So these intermediaries are going to stay a bit below 1. Now, what does it mean? It means that there is a bit of liquidity premium in the high state. And that's the state in which these risky securities are going to pay. So an intermediary can say, oh, I don't have to pay any monitoring cost. I see a rent there. I issue a defaulted security in the low state, but paying in the good state. I'm going to get that rent, and I'm going to supply this security. So everyone is going to do that. So what is going to happen? Consumption is going to be 1 in the good state, but it's going to be low in the low state. So this is going to be, now with tau equal greater than 0, a model of crisis. Okay? So it's a model in which, as you were saying before, there were issuance of private money, but that issuance was not safe. It was safe in good time, right? And they were paying in good times. But then when things turn out to be bad, you discover that these securities are not backed appropriately. So they're pseudo-safe securities. So they don't pay, and the liquidity crunch occurs. Okay, so that's what is happening here in the model. Now, how much money? How much time we have? Money, not much.
For an economist, we cannot save money.
How much private money we have here? There's no government money on the table. 5 minutes. Okay. So 5 minutes to tell you how we see through this model the government intervention there was in the crisis. And so now it is a model in which there is the private sector, laissez-faire equilibrium, is not efficient. Lead to this suboptimality of consumption in the low state. What the government can do? Well, Friedman was proposing, say, get rid of this private sector. They're going to provide always problem. Is the government that should do that? And the private sector eventually can issue liquidity, but they should be subject to a reserve requirement. At the end of the day, and this is also what Friedman was saying, you can back this liquidity by taxes or by something I'm going to talk here, which is interesting, the earnings on a portfolio of risky private assets. Second possibility, the government can reach the first best by insuring deposits. And that's the second possibility. And we've seen that, and we saw that in practice it works like this. Now, under these two solutions, the government doesn't have any limit on taxes. And in particular, what we need to enforce these two solutions is that the government should have enough taxes in the bad state, which is something sometimes not reasonable to have, because when the state is bad of nature, when there is the crisis, the government doesn't have enough taxes. Okay? So if we limit the government in the taxation in the low state, then the first best cannot be achieved. But still we see that these policies of insurance of deposits and of purchases of risky private assets are equivalent in terms of welfare. Now, the interesting result is, what about regulation? So regulation is a particular feature which doesn't require any taxes, right? You just impose some regulation. And regulation here it means imposing that intermediaries invest only in the safe technology. Now, this is going to lead to a second best allocation. It is going to be always not improving with respect to laissez-faire. Okay? So, I don't have enough time here, but I want to tell you two things. So the first is about how the government can achieve the first best or eventually a second best. Two things: taxes, okay, in the high and in the low state, but in particular in the low state. And the second thing they can do, the government, is backing the supply of liquidity by investing in a portfolio of security which are issued by the private sector, which are risky security. So these resemble a lot what central banks are doing nowadays. They are in some way investing in private securities, and they may be risky securities. So our model in this direction can give a rationale for this unconventional open market operation, not just because of the effect that they have on the transmission mechanism of policy, on monetary policy, but because they are a way to back the supply of liquidity. And to back the supply of liquidity by reducing a bit the burden of taxation. So let me tell you how. So if I invest in a risky private security in good times, this security is paying, and so my assets are good, and I'm paying my debt, which are the liquidity I provide to the economy. So basically, I'm offsetting my liability with the asset. So I don't need to have taxes there, right? So, but when things turn out to be bad, so it is a private security that the central bank are investing may lose value, then there the central bank has to pay liquidity. How can it do? Should raise taxes, okay? So again, taxes should be raised eventually, but in the low state. That's why it's similar to deposit insurance, because with deposit insurance, what you do, you basically provide insurance, you transfer to the intermediary some money in the bad state. So you are basically raising taxes in the bad state to insure the intermediaries, the value of their debt. So that's the first message. In a sense, it is unconventional open market operation. If we look from our model, are not something that should be temporary, but should be in the normal operation of a central bank, if we see that the government has some role in providing liquidity to the economy. Now, the second message is the regulation on intermediaries. And this regulation on intermediaries just always lead to a second best with respect to what laissez-faire can do. And I give you here the intuition. So laissez-faire, remember, is providing a lot of liquidity in the good state and the crisis in the low state. Regulation is basically equating the two. There is no crisis. But regulation imposes a limit on liquidity in the high state. So liquidity is not going to be good in high state. It's going to be a bit lower. So why regulation needs consumption to be low? Because you are going to impose to the intermediaries to hold safe capital, and to hold safe capital they have to screen and they have to pay this monitoring cost. But to stay in the market for this monitoring cost, they have to have some liquidity premium. So the consumption should be lower than the efficient level in order to give them some liquidity premium. Okay? So that's why consumption is low under regulation. And but this laissez-faire is good because without any cost, is producing some security which are eventually paying well in the good state, so they're rising this consumption, okay? And that's welfare improving. So in some way it means that you shouldn't regulate the private sector. You should allow this, production, excessive production of liquidity, excessive in a sense, efficient production of liquidity in the good state, and eventually face the cost of the of the bad state, okay? And there, if you can intervene with through the government by taxing and transferring money to the private sector and making insurance to deposit. Obviously, if you can, right? Because that could be costly. All right, so I think I'm in time. So what we did here in this work, we studied a joint supply of private and public liquidity, and we, in studying this, we discover a bit that this theme is not new in economics, and actually can be rephrased in using different words and terminology, recovering themes which have been characterizing financial crisis since the inception of the discipline in social sciences. And what we found here is that in this theme we can also recover some old debate between narrow banking, laissez-faire, free banking, or regulation that have been at the cornerstone of this financial crisis for ages. We find that in our model, if there are friction in the intermediation process, and we have this friction in the model, which is this monitoring cost, then pseudo-safe security are going to be produced, and those securities are the one that can create this crisis event. Now, what the government can do in this way is can improve welfare through liquidity provision, which should be backed either by taxes or by investing in risky security through the central bank. Can do deposit insurance. Instead, regulation of intermediary is not improving in our model, and although it avoids a liquidity crisis, is not improving in terms of welfare with respect to laissez-faire. So I hope I persuaded you that our framework, although simple, can rationalize some of the intervention we've seen during the crisis. And that's it.
Thank you.
Thank you very much.
Yeah, let's take a few questions, but also there's coffee outside and very good pastries if, anyone. Salim, then you?
Yeah, okay.
So thank you very much for your presentation. Very informative, and it links to what we're going through in Lebanon. Vice Governor Andari will be better to talk about it. So my question is more mathematical, and I was wondering whether if we extend the analysis to a multi-period analysis rather than one period 0-1, whether would that have an effect on the monitoring cost and then the equilibrium that you're showing us? Do you expect some changes at that front?
We started from a multi-period model, actually an infinite horizon model, but treating it as a cost exogenous and then constant over time didn't change the analysis. So basically that's why we collapsed to a simple two-period model, because everything was there.
Yeah, but these are your assumptions.
Yeah, these are assumptions.
My question is, these private intermediaries are benign. They're producing liquidity which achieves the first best. But what if there's irrational exuberance and they're producing more and more liquidity that really is, has nothing to do with CH or something like that? I mean, how would that fit in? Did I say something?
Yeah, this is, so if I interpret this, so it's not that they are benign in a sense, they are following their incentives, and so it comes that they're doing this. But if I see your question in a different perspective, and it's not the one we're dealing here, because this is a model in which intermediary are issuing debt, but not equity, okay? Now, if we instead of a model in which intermediary are going to issue also equity, then this overissuance of liquidity in some states have some negative effect on the good supply of liquidity of the private sector. So the laissez-faire equilibrium is going to be inefficient from a constraint perspective. While in this case, although it's not efficient from the first best perspective, but if you look from a constrained social planner problem, what the private sector is doing is constrained efficient. So there could be cases of externality which are not taken into account by this intermediary, and they could be fixed by the government.
Yeah, there you would have some role for government to bring back like a first best or something. Like
Something is constrained.
this is what people think about, I guess,
Yeah.
after the crisis when they worry about government regulation, right?
Because that could be a framework in which there is too much issuance. You know, it is benign one is going to be too much. You know, the government would like, a social planner in that context would like to keep it lower. Why? Because when you basically issue too much debt, you're lowering the premium for other agents, which is an externality for them because they need, some agents need to rise this monitoring cost, right? And in that model would be equity is going to be costly. Okay, so it's going to lower the supply of safe security too much.
One more question.
Sorry. The way I understood your presentation, that you are assuming that there are no time lags. If I understood correctly.
Yeah, that's
Because
good.
in the presence of time lags, synchronization becomes much more difficult.
Sure.
Taxation, regulations, and even intervention itself. Prepare for intervention and assess the amount of intervention.
Sure, this is this is left to policymaker. We just give ideas.
I just have a question about the state asset. In the bad state of the world, the banks, the intermediaries, let's call them, how can they, I mean, I kept on thinking, how can they sustain paying the payoff? Right? So
They don't pay indeed.
they're not paying it.
Yeah, they default endogenously.
So but then is it still a safe asset or can I...
No, sorry, so you're talking about the
So it's
safe.
a safe asset.
No, the safe asset in the bad state, since they invested in the good technology, that is going to pay.
Okay. But with the limited liability...
Doesn't apply to them.
You're assuming that there's limited liability. So
Yeah. But the technology in which they invest is going to pay in the bad state.
Okay.
So they're going to be solvent.
Okay, so they're going to...
So they don't have a problem of solvency.
Wouldn't the introduction of financial intermediaries that hedge the unsafe assets, the safe assets, be beneficial for the time of crisis versus time of the high state versus the low state?
So what do you mean by edge?
People who would pay, who would offer options on the pseudo assets, on the pseudo safe assets. That like CBSs, I mean, that you pay for them during the high state and then you would be reimbursed when they are in the low state.
Okay, so, well, this is going to be a private insurance mechanism.
Yes, it's kind of, it would mimic the regulation without being regulation. And it would be like the private issuance of regulation. It could be a balance.
Yeah, that's that we haven't investigated how it works, but it's obviously require resources, right? You know, so you need
the cost of the insurance.
right. So you have someone to pay that premium, and it should be sort of.
It's like a provision.
Yeah, it's like you inject equity into the intermediary in the time in which there is the crisis, right? Someone is willing to do that. Here. It could, in a sense, that there could be some issues about. Your agents are, you know, they have some sort of risk aversion, so you know, they could be possible to create a market like that. Yeah.
So when you talk about risky assets, you're mainly talking about the default risk, right? But not the interest rate risk.
Yes, that's the default
I'm
risk.
just wondering whether incorporating interest rate risk might probably matter, like a sudden change in the central bank policy toward lowering or increasing the interest rate.
That's an interesting aspect we didn't investigate it here. So because at the end of the day, we started actually with a monetary economy in the sense that there were prices, but then we made assumptions such that those prices were not effective in the analysis. Now, if you take in consideration also price movements, I think some issues are going to be some connection between central bank policy, conventional policy, and the crisis is going to occur, which I don't have an idea now.
Okay.
Okay, thank you. Thank you very much.
You can have coffee while we put on the next presentation.
Can I start? Or?
Yes.
Yes.
Okay. Well, first of all, thank you very much for the invitation. I mean, it's a pleasure to be here. It has been great so far. I'm really impressed about this campus and faculty and department. I'm going to present the paper on international food commodity prices and missing inflation in the euro area, which is actually part of a broader research agenda that I started recently, which is on the macroeconomic effects of shocks in global food commodity markets. Now you may wonder, why do you care about it? I mean, agricultural fluctuations, they were considered to be important for business cycles more than 100 years ago, but not if you look more recently. Well, I find it a bit surprising. I find it a bit surprising that people do not take that seriously for business cycle fluctuations, because, for instance, if you look at the US, 17% of US household expenditures are food related. Of course, that's not only food commodities, it's also food services and processing and so on. However, 14% in turn of that 17% are actually the raw commodities, which is the meat, which is corn, which is rice, fish and so on. Really the commodities, fruit, vegetables and so on. Well, if you calculate that, that corresponds to roughly $900 food commodity expenditures per capita per year, yeah? Which is quite a lot, which is substantial. If you compare that, for instance, with crude oil, yeah? If you really look at the crude oil, the raw commodity oil, in total expenditures of households, well, then that corresponds to $750 per capita per year. So it's bigger, larger share than crude oil, and you have hundreds of papers looking into the macroeconomic effects of all shocks, all supply shocks and whatsoever. So that's what I find really surprising, and that's when I started to address this question, how important this is for macroeconomic fluctuations. And I think it's not only important to study business cycle fluctuations, because that share is even larger if you look at low developed countries, but I think it's also relevant if you want to analyze policies that may influence food prices directly or indirectly, like public food security programs. Well, you need to know what are the effects of shifts in food commodity prices. Agricultural trade policies, import restrictions, export bans, ethanol subsidies, and other, like say, programs that might influence food commodity prices. And I think it might even matter, it matters even for climate change, because climate change could affect countries indirectly via having a rise in the variability and the frequency of extreme weather shocks in major agriculture producing regions. Yeah, I'll take an example, the extreme droughts in Russia and Eastern Europe in the summer of 2010, well, that triggered a rise in global real food commodity prices by almost 30%. And that could indirectly influence the US economy via having higher food commodity prices. El Niño. Yeah, that's a global weather phenomenon that also could influence this. Now, the focus of this paper, so this is part of a wider research agenda, is having a look at what's the influence of international food commodity price shocks on inflation. And I look here at inflation in the euro area, and the euro area inflation dynamics. Why does it matter? Might it matter for inflation? Well, if you look at these shifts in real international food commodity prices, these are quite substantial. And in the end, food commodity prices are the major input factor in the food production function, and that might indirectly influence food consumer prices and therefore also inflation more generally. And you see that these swings are huge. In a relatively short period, you have here a rise of plus 70%, minus 50%, 40%, and so on. So these swings are quite huge and may influence inflation, which is of course important for monetary policy. Why? Well, food-related items have in turn a very large share in the harmonized index of consumer price, which is the index which is the ECB targets. So if you look at that, well, about roughly 27% is directly or indirectly related to food prices. So you have processed food, unprocessed food, but also catering services. Of course, food is a small share there, but it still indirectly is part of that component of the HICP. So about 1/4. Moreover, what of course also matters is inflation expectations. Inflation expectations, you know, in any macroeconomic model with forward-looking agents and sticky prices, then inflation expectations in the Phillips curve is a really crucial determinant of inflation itself. Well, the share of food informing inflation expectations is even larger than its share it already has in the HICP itself. For instance, a recent survey of the Norges, they asked to all households, well, to what are you looking most at to form your inflation expectations? What's the crucial variable for you? Well, 61% of households, they look at prices of food to form inflation expectations. Only 12% looked at the overall price index, and only 4% looked at gasoline prices. So food seems to be key to form inflation expectations, which in turn matters for inflation itself. So that's why I think this is something relevant to study. Moreover, and that's also a bit one of the questions I ask in this paper, is that these swings in international food commodity prices due to droughts and good harvests and so on, and events in food commodity markets, global food commodity markets, may have contributed to the so-called twin puzzle of missing disinflation and inflation after the Great Recession in the euro area. I mean, this got a lot of attention by academia, but also by policymakers, is this twin puzzle is what we actually have in the euro area. So the ECB has a target of inflation below but close to 2%. Well, as you could see here, that's in the period 2011, 2012, well, inflation was above the target. But at the same time, the euro economy was in a recession. And we were closely after the banking crisis in 2009, but also then we had the sovereign debt crisis in the euro area. So that was a bit of a puzzle, that despite the very low economic activity, despite the recession, inflation was relatively high. So that's the missing disinflation period. Then afterwards, after 2013, what we see is actually that the European economy was recovering well. The economy was going quite good, decent numbers, and at the same time inflation was really low, was far below the target, and that's what we call the missing inflation period, and that's what inspired the ECB to start quantitative easing programs and so on in order to avoid deflation and increase inflation. So where was the inflation? That's the missing inflation period. Well, if you look at the swings in international food commodity prices, then there is like a strong movement between the two. Many people will refer to the oil price, and some studies have analyzed the interrelation with the oil price that also made such swings during that period. However, if you look at, for instance, 2010, 2012, well, we had then these droughts in Eastern European, droughts in the US, and so on, and that might also have triggered a higher food commodity price and have raised inflation. On the other hand, 2014, 15, well, global harvest conditions were excellent. Harvests were really good, and that also lowered real food commodity prices and might have passed through to inflation more generally. Now, am I the first study asking what's the relationship between food commodity prices and inflation more generally? Well, that question in itself not. I mean, you have the Fed, the ECB, the IMF, they all have a lot of evidence, but the problem with all that evidence is that it's actually reduced from time series models. They only look at and explore unconditional co-movement in the data. And they make it like an assumption, like a pricing chain assumption. So very simply, I mean, you have many studies, but in a sense what they are doing is they just regress changes in consumer prices on contemporaneous and lag changes in food commodity prices. And then they just interpret it as, okay, this is a causal effect because food commodity price, that's very flexible. Consumer prices, they react a bit sticky. Well, if you find an immediate or lagged impact, well, then the causality goes from food commodity price to consumer prices. But in a sense, you cannot give that a causal interpretation. That's just a correlation that you find. And this can be informative about signaling role of food commodity prices for future inflation, but you can never give that a causal interpretation. It could perfectly be that there is an aggregate demand shock that has an immediate effect on food commodity prices, because you know demand is going to increase, more economic activity, food commodity prices increase, and after a while, due to the demand shock, consumer prices starts to increase without having any causal effect over there. Or maybe it's the oil price, because oil being for biofuels being a substitute, the oil price could increase, while immediately food commodity price could also increase, and after a while the oil price could influence consumer prices. So it's just a correlation, signaling role, it's not a causal interpretation that you can give. And that's the contribution of this paper, is really looking at the causal effects of shifts in international food commodity prices on euro area inflation dynamics over the period since 1970 until more recently. And what I'm going to use here, well, it's a purely empirical paper, structural VAR model, and which I'm going to identify with external instruments in the spirit of Stock and Watson and Mertens and Raven. And what I'm going to do here, what I'm trying to sell here, what I'm also using in the other papers of that research agenda, is an external instrument. I'm going to look at harvest shocks as an external instrument to identify exogenous food commodity price shocks. Yeah. And then I'm going to analyze the contribution to the twin puzzle, the relevance for inflation fluctuations, and I'm also going to look at the pass-through more carefully. How do these shifts affect consumer prices? So as a baseline, I have here a structural VR model for the euro area. So in that structural VR model, I have 8 variables. 4 of them are more, for the euro area point of view, international variables. So of course I have international real food commodity prices, which is measured in US dollar. And that's the variable that I would like to see the shock of and the consequences. I also include international real crude oil prices, of course, being a substitute, and might also have an influence on food commodity markets and euro area inflation dynamics. Of course, I include the euro-US dollar exchange rate, the bilateral exchange rate, because these are measured in US dollar to have a pass-through to the European economy. I have real exports of the euro area, which captures, let's say, economic activity of the European trading partners. And then from the euro area point of view, I include real GDP, real personal consumption, the short-term nominal interest rate to capture monetary policy, and then of course the HICP, which is the index of consumer prices of the ECB. So I estimate this VER with 8 variables over the period, this quarterly period 1970 until the end of 2016, with 4 legs. I don't know whether you're familiar with structural VER models, but the crucial thing here is the identification of shocks. So in the end, what you have here, these residuals that you have here, these are a combination, let's say in that first residual, is a combination of exogenous international food commodity price changes and endogenous reactions of international food commodity price to all other kind of macroeconomic shocks that are out there. Yeah? And the key thing is here to disentangle these two. And what is typically used in the literature is imposing restrictions. Let's say a Cholesky decomposition is imposing 0 restrictions about the interaction of these variables in the short run, or long run restrictions or sign restrictions. You have these kind of methods. I have used these also in the past. Well, in recent advances in these econometrics, they use actually external instrumental variable to disentangle these exogenous changes in food commodity price from endogenous changes to other variables. Yeah? So that's what recently has been started to use, for instance, in the context of fiscal policy. Disentangle exogenous spending shocks from endogenous increases in spending to changes in economic activity. Now, what is the key idea here? Well, like any instrumental variable, it's not the full shock series itself, yeah? But you need to reflect an exogenous component of your target shock. So in the end, you need to have an instrumental variable that is correlated with your exogenous shifts in international food commodity prices, but uncorrelated with any other macroeconomic shock which is out there. And that's the key here. And that makes it also difficult in the context of food commodity price, because food commodity prices react to any shock in the economy, typically on impact. So what I do here, what I use as an instrument, well, I look at unanticipated harvest shocks. So I'm going to look at harvest shocks as an instrument for changes in food commodity prices. Why do I want to look at harvest shock to do that? Well, here I explore the fact that harvests, they cannot react within 1 quarter to economic shocks. Yeah? A harvest cannot, this is quarterly data that I have here. Food commodity prices can react within 1 quarter to any shock in the economy, because it's a very flexible variable on international markets. But harvests cannot react within 1 quarter. Why? Because there's a time lag between 3 and 10 months between the planting and the harvest of cereal commodities. Yeah? So in a sense, if the economy is booming, what you could do as a farmer, you can start planting more, but you cannot harvest more within 1 quarter. Why? Because there's a lag of at least 3 months. And what happens within those 3 months is your harvests are subject to a lot of unanticipated autonomous shocks. For instance, caused by weather variation, pests or disease that influence your actual harvest within that last quarter, and that could be a shock, and that could be an instrument. Yeah, for changes in food commodity prices. So that's the whole idea. Harvests cannot react within 1 quarter to the economy, so what happens in that last quarter before the harvest, but your volume of harvest, that's an exogenous shock. And that's a good instrumental variable that you could use. Now there's one problem here, that is, of course, you need to have this at the quarterly frequency in order to work. Well, the FAO publishes only annual harvest data. Yeah, so there's only annual harvest data available for the 4 most important staple food items, so corn, wheat, rice and soybeans. Yeah, so they have this data for 190 countries since the early 1960s. Now these 4 staple foods together, they account for 75% of all calorie consumption worldwide. So that's a lot. Why? Because they're also used to produce meat, for instance. So indirectly, they account for 75% of all our calories. So that's quite a lot. But how can we then move from this annual data to quarterly data? Well, that's what I've done in the first paper together with Yasmin de Win on that. That's a Brookings paper on economic activity. So what we do there is we start to combine for these 192 countries, so almost 200 countries, 4 staple food items, so that's 800 harvests. So what we did is we started to combine these annual harvest data, but for each of these 800 individual harvest calendars in order to allocate annual data to individual quarters. And that's possible because mostly the harvest season is relatively short. I give an example here. Kazakhstan wheat. Well, we know that the planting is always in May and the harvest is always in August and September. So the annual wheat volume in Kazakhstan, well, we can allocate it to the 3rd quarter. And that's what we have done for all these countries, and that way we managed to allocate 2/3 of global harvest of these 4 to individual quarters. Yeah, some we were not able to allocate because some countries just have harvest during the whole year. And there we do not manage to allocate it, but in the end what we need here is an instrument. Yeah, an instrument for a shock, and therefore we managed to allocate 2/3 of global volumes to individual quarters. So what we do then, we aggregate these 4 harvests by their calorie, so that we have one global indicator of global harvest of these 4 staple food items. Yeah. Of course, we need to have an unanticipated harvest shock within the last quarter. So in order then to get these shocks, what I do here is, so I estimate the harvest shocks by including, so the left-hand side variable is the global harvest volume. I do not include European harvests. The reason is that I want to avoid to have somehow spurious direct effects on the European economy. Yeah, why, for instance? Well, you could have a weather shock having a direct effect on economic activity and at the same time influence the harvest of the of European farmers. So that's why I look at harvest from the rest of the world. Let's say I exclude European harvest. So I regress that harvest volume of an individual quarter to on a constant trend lagged variables. So I include 8 lags of harvest volumes, and then also a number of economic variables, also 8 lags, that could influence your harvest with a lag of 1 quarter. Yeah? Because after 1 quarter, it's possible that these harvest volumes react to changes in economic activity or changes in crude oil prices. So I include all these variables as control variables. And so the residual that you have here, that's an unanticipated harvest shock. That's a change in harvest that you cannot predict by any of the economic activity variables, and that's something which is really exogenous, because within the last quarter you cannot react to changes in the economy. So that's the external instrument that I'm using in order to identify exogenous shifts in international food commodity prices. So here you see the variability of these harvest volumes has been substantial. That's the indicator global harvest volumes. So this is a 100 times log, the natural log of the global harvest volume. And here you see the unanticipated harvest shocks, that you see that the standard deviation of these shocks is about 4.3% of global harvest volume. So this, it's quite volatile, it's quite substantial. Now fortunately for me, this harvest shocks turned out to be a strong instrument for food commodity price innovations. If you look at the F-stats and robust F-stats, I mean, they are mostly around 15 or between 13.9 and 17.4. So these harvest shocks seems to be a strong instrument for changes in real food commodity prices. So then I look at the dynamic effect of a change, a 1% increase in real international food commodity prices. So these are the dynamics. So you have a 1% rise on impact, and then you see quarterly horizon, what's the impact over time of a 1% increase in international food commodity prices. And then you have the error bands, so the dark gray is plus and minus 1 standard error, and then you have, let's say, these light is like 90% confidence bands. Yes.
The confidence intervals, how were they computed, the confidence band?
I have used the bootstrapping method of Mertens and Wave. Yeah, that's the way that I have done this. Now, as you could see, so what happens after this 1% increase? Well, it's increased even further after 1 quarter to, let's say, 1.4%. Well, that shock triggers a decrease in economic activity. You see a decline in real exports, also in economic activity in other countries. That's what I've shown in the other paper. There's a decrease in real GDP, which is quite strong. I mean, in the other paper, we show that this effect is stronger than an oil price shock, than a corresponding oil price shock. Real personal consumption also decreased. Now, what is important here in the context of this paper, well, it has a significant and substantial impact on the HICP. And so you see after, let's say, 1-2 years, there's a rise of, let's say, 8 basis points in the consumer prices after a 1% increase in food commodity prices. Other relevant impulse response, so you have a tightening of monetary policy, the interest rate increases. The crude oil price does not do anything on impact, so the shock is really orthogonal to any change in crude oil prices. And as you could see also here, and that's also important to understand the pass-through to inflation, there is a depreciation of the euro exchange rate versus the US dollar. Yeah. There is a depreciation, which was a bit surprising. A possible explanation could be that the US is a net food commodity exporting country and the euro area is a net food commodity importing country. And that could be the reason why you have this depreciation of the euro against the US dollar on impact. How important are these changes in international food commodity prices for inflation dynamics in the euro area? Well, here you see the contribution to the forecast error variances of some key variables within the VER. So how much of the forecast error variance is explained by exogenous food commodity price shocks? Well, food commodity prices themselves on impact 60%. If you want to make a forecast error variance a more longer horizons, it's only 25%. So at longer horizons, it's mainly endogenously driven by other shocks in the economy. However, nevertheless, what you could see is it explains, let's say, at a horizon of 1-2 years, up to almost 30% of HICP volatility in the euro area. For real GDP, it's less important, it's less than 20%. It's 12% in the long run of volatility, so it's not that crucial for GDP. But for inflation, it's quite important shocks. It turned out to be quite important. What about the twin puzzles? Yeah, remember the twin puzzle in the euro area. So what if you do a counterfactual analysis? So what if you look at how would food commodity prices have evolved without all these exogenous shocks that are driven by events in food commodity markets? Well, what you could see here in this slide, this green dotted line, that's the baseline evolution of the VR, which is the case where you have no shocks at all in the economy. All the difference between the actual and the baseline is explained by the shocks that are included in the VR, which I do not identify individually. I only identify the food commodity price shocks. And then the red line, what you could see here, that's the counterfactual without food commodity price shocks. How would food commodity prices have evolved without the shocks? Well, here you could see that without food commodity prices, the period 2012, 2011, 2012, that food commodity price would have been 18%, 12% lower without these exogenous shocks. So it could have contributed to the missing disinflation. Also here, we had this period of very favorable harvest shocks. Well, without these shocks, food commodity prices would have been 26% higher. So the shocks actually have lowered international food commodity price, which could have lowered also inflation in the euro area during that period. And that's exactly what I found here. That's exactly what I found here. These shocks did contribute to both the missing disinflation and the missing inflation in the euro area. So here I again do a counterfactual analysis for the European inflation rate. So HICP year-on-year inflation. So here you have the target of 2%. So if you look at this specific period, then you see that inflation would have been between 0.2 and 0.8% lower without these exogenous food commodity price shocks. So inflation actually would have been in line with the target more or less without these food commodity price shocks. Also, if you look at the missing inflation, well, of course, it's not the only explanation, but it's a part of the explanation, and it matters if you look economically. Well, inflation would have been between 0.5 and 1% higher without these shocks, exogenous shocks in international food commodity markets. So that's quite a lot. Now then the next question I ask, how much time do I have, more or less?
5 to 10.
5 to 10, okay. So the next question I ask is, how are these international shocks passed on to consumer price? Why do they have such a big effect? Well, first I construct a number of internal market prices, because these were global international food commodity prices. So I also constructed some European food commodity price indicators, and then you see that there is a pass-through. There is a pass-through, but less than proportional. So European commodity prices increase, but less than proportional. Especially cereal commodity price, because that's closely related to the international commodity price indicator, but also meat commodity price, for instance, they start to increase because these cereal commodities are used as an input factor to feed these animals, while also meat commodity prices seems to increase. Dairy commodity price seems to increase, and even food commodity prices seems to increase, because that might be a substitute or somehow also correlated, because fruit is also a bit driven by similar shocks, weather shocks, as cereal commodity prices. So there is a pass-through to European commodity prices. Moreover, if you look along the food production chain, if you look then at final retail prices of food in HICP, then also there you see that there is a significant pass-through. So the red dotted line, that's the pass-through of HICP excluding food and energy, which is core inflation, which has nothing to do with the shock. Well, you see that these food components of the HICP, meat, fish, fruit, vegetables that you pay in the shop, well, these react more than these, let's say, than these non-food core inflation rates. So there is a pass-through again, but again, much less than proportional. So if international food commodity price increased by 1%, well, meat prices in the shop increased by 0.15%. If you look at food services, well, there we do not see a stronger impact. So if you look at food services, catering services, the price you pay in restaurants and cafes, canteens, well, these prices, they react the same as HICP excluding food and energy. So you don't have to pay more going in a restaurant than you have to pay for, let's say, a haircut if you go to the hairdresser. So these prices react quite similarly. So there's not a stronger pass-through there. However, what is surprising, and explains why I find such a big overall effect, is that there is also a significant increase, so not only of unprocessed and processed food items, which is normal, that's via the food production chain, but there is also a significant increase of HICP excluding food and energy. And surprisingly, there's also an increase of HICP energy. And then the question is why? Why do these two also have these indirect effects that also ultimately have a pass-through to inflation? Well, here I have to come back to the depreciation of the euro. That is triggered also by the shock. Remember, why does HICP energy also increase? Because at the same time the real crude oil price does not move at all on impact. It does increase after a while a bit, but not really significant. However, of course, because the euro area is an all importing country, and if the international food oil price remains constant, but you have a depreciation of the euro and a depreciation of the nominal exchange rate, then of course oil prices measured in euros will increase. And that explains, the depreciation explains, and also here the import deflator, why you have this rise, this strong rise in HICP energy. And why does HICP excluding energy and food increase? Well, also because import prices become more expensive, and that drives it partly. Another reason for having that is inflation expectations. If you look at price expectations based on the European Commission survey of inflation expectations, survey of professional forecasts, then you see that inflation expectations do increase after the shock. And that of course has then could have second round effects on the inflation rate itself. And for instance, if you also look at nominal wages, in Europe, of course, employees will ask higher wages whenever they have increase in their inflation expectations. Well, you see that nominal wages also increase significantly. And that, of course, drives then, in the second round, also costs of firms increase, also drives that way inflation much higher. So these indirect effects. So how much time do I have? Do I have to finish? 2 minutes? Well, let me then show one thing. These results are very robust for alternative specifications and so on. The only time when it's somehow sensitive, if I look at the more recent sample period. If you look at more recent periods, you see that the pass-through to inflation is much less and is less persistent. That doesn't matter for the variance decomposition, it's even more important for the variance of inflation. That's because all shocks, I mean the variance of inflation itself has decreased over time. It does not matter for the historical contribution, for the twin puzzle, but it does matter for the pass-through that they have on inflation. And why? Well, the effects through the food production chain do not change over time. It has to do with these indirect effects. So the indirect effects appear to be somewhat smaller over time. Why? Well, the depreciation of the euro is a bit less in the recent sample period. And nominal wages do increase much less in the more recent sample period. So, I mean, employees do not manage to raise their wage as much as over the whole sample period, even though inflation expectations increase to the same extent. Another thing, and that's my final slide, that has changed over time, it's the pass-through via energy prices. Yeah? There's a stronger pass-through via HICP energy. And why is that the case? Well, because now there's also pass-through to real crude oil prices. So the oil price does also increase after a rise in international food commodity prices. And this can potentially be explained, and that's something that I'm now exploring in a separate paper, by the biofuel revolution. So actually food commodities and oil have become substitutes over time, and because they have become substitutes, rise in the price of one of the two also triggers a price increase in the other one, which was not the case over the whole sample paper, but it seems to be the case more recently, and that's what I also find in another paper, and therefore you have a stronger impact also on HICP energy. So it's biofuels, but also informational frictions in commodity markets. Due to globalization, there's in the finance literature models that show that traders, they see a signal, and when they see a rise in food commodity prices, they interpret this as an increasing global economic activity, and they start to demand and to buy more oil, crude oil, and that also increases the oil price, and so you could have a pass-through there. So let me just conclude. Fluctuations in food commodity prices, they matter for euro area inflation dynamics. They have a strong impact, explain quite a lot of the volatility of inflation. It matters also for both the missing deflation and inflation after the Great Recession that we have. This transmission mechanism, there's a direct effect that we all expect, but there's also these indirect effects, depreciation of the euro, and then second round effects via rising wages that amplifies the consequences on inflation. There appears to be time variation, but that's something that should be explored a bit more in detail.
Thank you. Take care of your questions, Salim.
What's up?
Yeah.
Thank you very much for your presentation. I'm really sorry I didn't read the paper before attending the presentation. It's very rich and we can see it. You have quite a bit of variables within and then implications. When you started your presentations, I mentioned El Nino, and as you know, this El Nino phenomenon is about this band of warm ocean water that happens in the central equatorial Pacific, and it affects usually the prices of crops, and then we can see that this happens with some specific frequencies every 3 to 7 years. We follow it in the financial markets. It has an impact in the following, let's say, 3 to 10 months as per your cycle on commodity prices, and then we can follow it. We had it in 2004, 2006, 2009, 2010. We had it in the 14-16 period, and we're talking about a weak probability of El Nino event in 2018 that could affect prices starting 2019. And then my comments is related to your unanticipated shocks, and I was wondering whether you can elaborate more on those shocks. Do we have any probabilistic analysis related to that? To which extent they are unanticipated?
Well, that would have been my reply, because what you are explaining, that's something which is anticipated.
Yeah.
You know that El Nino is coming, and this will be reflected in prices. And that's not an exogenous shock the way that I identify it here.
Can you give us an example about your exogenous shock?
The example is like the droughts that we had in Russia and Eastern Europe in 2010. So what happens is, so you had the anticipation that harvest will be normal, and what happens during the summer months, which is the month of the harvest, you suddenly had much hotter weather than was anticipated, and that weather destroyed part of the harvest or resulted in less harvest, and that's something that happens during that quarter.
See, this is my point. I mean, I'm talking about it because at the same time we had the Russian event, we had a Nino effect in Latin America. And so there is a kind of combined effect, because we were anticipating some pricing effect in that same period, 2009,
okay,
2010.
but that El Nino has somehow control for that, because that, if the price, I include the price variable, and if it's include, I mean the price variable should include all information that's out there before the start of the harvest season. So it could only be during the harvest if it's a surprise. So that's a first comment I can give. A second comment is actually in the other paper we actually studied that also by just controlling for El Nino. So we included 3 variables that capture El Nino, the dummy and some others, and we orthogonized the shocks to avoid to have El Nino. Yeah, because also here El Nino could also influence the European harvest, and I actually once controlled for that, and that doesn't actually matter for what I find here.
Just wondering, what did you use instead of the euro before 2002 for the exchange rate, and
that's it.
Also before the 90s, we didn't have the same use of GMO crops as today. Can this explain also the change? Like there's a regime change in the way international, I mean in the way harvest react, because we know with GMOs, for example, the season can be longer, it can be more robust to fluctuations in climatic conditions. This was not the case in the 70s.
Yeah, well, to comment, the data, it's the construction, it's like a weighted average of individual countries before 99. I mean, these data, they circulated. You have the area-wide model, and these data, quarterly frequency, go back to the 1970s, and that's actually the data set I have used here. They are used in many applications. Now, in terms of course, there's also technological evolution in these food commodity markets, and actually, if you look at the shock has become slightly smaller over time. If you look at the variability, so food prices have become more volatile, but the harvest shocks not. So if you look at that, it has decreased a little bit, and that could be because of better technology. So, but then it's just a smaller shock that I have, and that's what I take into account there.
Well, thank you very much. I mean, this is extremely enlightening for me. Now, you've explained the inflation dynamics. I'd like to come more down to earth. Is there a policy implication for this, or this is something that the governments have to take for granted? There's nothing they can do about it. Is there a policy thing that you can do about it? Is there anything that can be done to face it?
Well, for central banks, of course, and that's the question I ask you for inflation. For them, it's important to know that, for instance, in theory, they're saying, yeah, if it's like, if the ECB says we only look at core inflation, maybe food and all that's very volatile, that's only temporary. But if you have these kind of second round effects, that means that it will also affect in the end core inflation. And that means that the central bank, that you do have to react to it to stabilize it.
Knowing this, now reading your paper and getting the results, what can they do? And what is it that can be done? Is it something we have to accept as a...
well, potentially you can do. I mean, here again, the focus is here inflation. But for instance, what you have this common agricultural policy of the European Commission. And actually the aim of that program was to isolate European agricultural prices from shifts in the rest of the world. And they have designed that program, and they thought by giving subsidies to farmers in order to compensate price shifts, in order to stabilize European prices. And they thought that they were successful in doing that. Now, next week I'm going to present at the European Commission. It seems that there is still a pass-through. Also, if you look more recently, after the 90s, there's still a pass-through to domestic prices. So one thing could be that maybe they have to revise their program in order to try to stabilize European prices, and then the pass-through might become smaller. That's an issue here. I think in terms of policy, what might matter also more is these output effects. And then you might have to think, because they are quite strong also in the US, you might have to think in terms of food security programs to somehow protect, let's say, because it's a large share in poor households, they spend a lot on food in their total income. Maybe you have to protect these people a bit more with food security programs as such to not have amplifying effects on the macroeconomy, for instance. So that could also be one of the consequences.
It seems that the shock, the 1% shock, is being integrated in the HICP, meaning that it's like the HICP is like the integral of the food commodity price. By that I mean that once the positive shock 1% is put, the HICP goes up, and then when it comes below zero, it stabilizes to the level of 7 basis points.
Yeah.
So my question is, does this mean that a negative shock on the food price would not be taken into account in the HICP, while it will remain at a higher level, while a positive shock is...
But these estimates are symmetric. So this is the consequence on the HICP of an increase. And if you have a decrease of 1%, you will have a decrease of the HICP. So you wonder why this is persistent and this is temporary. Yes. Well, this has to do with these second round effects. Why? Because wages start to increase. So if wages start to increase, nominal wages, and they in the end they increase permanently. Yes. But that's because you have a wage price spiral, right? I mean, if wages increase, the price increase, the costs increase, and then in the long run, even though the initial shock has disappeared, you have a permanent increase in these two nominal variables.
So basically, the positive shock has a longer term effect than the negative shock.
No, the negative will be the same, because then you will have less wage increases. So it's like these impulse responses are like a counterfactual.
Not a wage decrease.
Yeah, no, wages will increase less than they would otherwise do. That's the implicit assumption. But there is symmetric assumption here. So it's by assumption, these two shocks are considered to be the same.
Yeah, so when you conduct an analysis on different food commodity prices, So do you run the VAR model separately for each commodity?
Yeah, so for these extra variables you mean, eh? Yeah, I went a bit fast through that, because what I actually did is one by one extending the VAR by one variable, but I estimate a near VAR. So the shock and the basic variables are not affected, it's just one extra equation.
That would imply that you assume some sort of independence between different commodity prices, right? Like, because as you mentioned, so for example, meat prices could possibly affect fish.
Yeah, but that's the same with the baseline, right? I mean, in the baseline, you assume that the economy is driven by these 8 variables, and that assumption I maintain, just not to avoid that by having another price that somehow the dynamics change, and also it has to do with the sample size, because for these additional variables, I do not have them over the whole.
Because I'm wondering whether if you use like a factor augmented VAR, so that way you don't have to do identification across, you know, that strong independence across different.
Yeah, I have considered to do that initially, and then I started to move to this simple.
And then, as you mentioned, there's some evidence of time variation, probably like doing a time varying.
Yeah.
Because you have that.
But that's what I do. But the problem with the time varying VAR is you can do that with at most 4 variables.
Oh, 4 variables. So here you have many.
And here I need so many, and then also your instruments should be time varying, and then it makes it very difficult. But you're right, and I do that for very simple to pass through to all prices. I do that.
Sorry. So just the issue of including that many variables, like 8 variables already in the VR, so also one would wonder whether like working with a more parsimonious model would probably, because you already have like an external instrument that is improving a lot your inference. So are there any added benefit of including some, you know, or is it a need to have 8 equations already?
Yeah, but that's because I use that also to derive the underlying shocks, and the less variables that I include, the more important will be my shock. And then someone will say, yeah, but that's because you do not have many variables, you're missing the oil price, you're missing export, and you're missing exchange rate shocks, and now you all capture these shocks in your historical decomposition and variance decomposition as a food shock, whereas these are other shocks that have a similar pattern. And the more variables that you have, these impulse responses, the easier you can find the underlying shock. That's the reason. That's why I need
One
many.
last question.
So, but just an econometric question. So I think the inflation and the commodity prices would be both highly persistent. Or not? So I've seen work by Fed economists looking at oil and inflation expectations.
Yeah.
And they find a high correlation between these two over a certain period. But then the argument is that because both are highly persistent time series, they look deeper into the underlying causes of that, if there's a common factor or anything like that. Is this the case for the European data, or I've never looked at the
But the data, of course, I mean, inflation expectations and oil and food, I mean, they are strongly correlated. But what I'm looking here at are exogenous shocks in one of these variables, and then I estimate the pass-through via the system that I have here, right? That's what I try to do. Yeah.
Okay, I guess thank you so much.
Thank you for the comments.